Welcome to my YouTube channel. Today we will discuss. Every single investor in the precious metal space is asking the same question right now. Should I put my money in gold or silver in 2026? Both metals have been on fire. Gold has surged past $5,000 per ounce. Silver hit an all-time record of $121.67 per ounce in January. Both are near historic highs. Both have made investors extraordinary amounts of money. But here is the truth. They are fundamentally different assets. They carry completely different risk profiles. They are driven by different forces, and they will behave very differently going forward. Today we are putting them side by side, gold versus silver. And by the end of this video, you are going to have a clear, data-driven answer to which metal has more potential to make you money in 2026, and which one is better suited for your specific situation. Let's get into it. Section 1. The scoreboard, how each metal has performed. Let's start with the raw numbers because they tell a remarkable story. In 2025, gold delivered a stunning return of approximately 70% for the full year, one of the best annual performances in the yellow metal's modern history. Gold climbed from around $2,600 per ounce at the start of 2025 and finished the year above $4,400, setting more than 50 new all-time highs along the way. By January 29, 2026, gold hit its current all-time high of $5,626 per ounce. Today, as of March 1, 2026, gold is trading around $5,163 per ounce, still up a staggering 74% year over year. Silver's story is even more dramatic. In 2025, silver gained approximately 148%, more than double gold's performance. Silver started 2025 near $30 per ounce and climbed all the way to its January 29th all-time high of $121.67. Today, silver is trading around $93 to $94 per ounce, up roughly 184% year over year, even after its brutal 31% single-day crash on January 31st. So on a pure return basis, the score for the last 12 months is clear. Silver has dramatically outperformed gold. A $10,000 investment in gold 1 year ago would be worth about $27,400 today. The same $10,000 in silver would be worth approximately $28,400, and at its January peak was worth over $40,000. But past performance is only part of the story. Let's look at why these metals move the way they do. Section 2. Head-to-head. What makes each metal tick? Gold and silver are both precious metals, both priced in dollars, and both benefit from the same macro tailwinds: a weaker dollar, lower interest rates, geopolitical tension, and inflation fears. But beneath those shared drivers, they are completely different animals. Gold is primarily a monetary asset. Roughly 90% of gold's demand comes from investment, jewelry, and central bank purchases. Central banks are the most powerful force in the gold market right now. JP Morgan forecasts 800 tons of central bank gold buying in 2026. That's approximately 26% of annual mine output going directly into sovereign reserves, a demand source that has no equivalent in silver. Gold's market is enormous, estimated at over $20 trillion, which means it has deep liquidity, lower volatility, and responds primarily to monetary policy, inflation expectations, and geopolitical risk. As one veteran portfolio manager at one point BFG said, and I'm paraphrasing their analysis, gold's underpinning is robust central bank buying combined with pent-up demand from Western investors and expectations of Fed rate cuts. Silver is a dual-natured asset. About 50% of its demand comes from industrial applications: solar panels, electric vehicles, AI data centers, semiconductors, 5G infrastructure, and medical devices. This gives silver a powerful additional engine that gold simply doesn't have. When the global economy is growing and technology is advancing, silver gets an industrial demand tailwind on top of all the monetary tailwinds that also drive gold. Demand from the electrical and electronics sector has surged 51% since 2016 alone. Analysts at the Gold Advisor describe silver as being like a jet ski compared to gold's cargo ship. Same ocean, same general direction, but a completely different ride. Silver moves 1.5 to 2 times as dramatically as gold on any given day in percentage terms. In a bull market, that means much bigger gains. In a correction, it means much bigger losses. Silver's January crash of 31% in a single day versus gold's 11% crash on the same day perfectly illustrates this dynamic. Gold versus silver. Full comparison table factor. Gold. Silver. Current price, $5,163 per ounce, $93.80 per ounce. All-time high, $5,626, January 29, 2026, $121.67, January 29, 2026. 2025 full-year gain, plus 70%, plus 148% year-to-date. 2026 gain, plus 74% year-year-year, plus 30% year-to-date, plus 184% year-year-year. Daily volatility lower, 1 times base, 1.5 to 2 times versus gold. 10-year CAGR, 24.8% varies, higher. Short-term market size, $20+ trillion, $1.5 trillion. Industrial demand, 10% of demand, 50% of demand. Central bank buying 800 tons, 2026 est. None. Supply deficit modest, 6th consecutive year. Risk profile lower, safe haven higher, industrial beta. 2026 bull target, $6,300, JP Morgan. $100, $150, Citi, B of A. Upside from today, plus 22% to $6,300, plus 60% to $150, Citi. Section 3. What Wall Street is saying, the official forecasts, 6 to 8:30. Now let's look at what the world's biggest financial institutions are actually forecasting for each metal in 2026, because the data here is extraordinary. For gold, the consensus among major banks is aggressively bullish. JP Morgan has set the highest major bank target for gold at $6,300 per ounce by end of 2026, a 22% gain from today's level of $5,163. Wells Fargo puts the range at $6,100 to $6,300. UBS targets $6,200. Deutsche Bank, Societe Generale, and Bank of America all see $6,000. Goldman Sachs is slightly more conservative at $5,400, while Morgan Stanley's bull case is $5,700. The structural driver behind all of these forecasts is the same: central bank reserve diversification. JP Morgan's head of global commodities strategy describes the trend as an ongoing, unexhausted structural diversification toward real assets over paper assets, a reserve currency paradigm shift driven by the global move away from dollar dependence. For silver, the forecasts are more divided, reflecting silver's higher volatility and the uncertainty around its dual industrial and monetary role. JP Morgan is the most cautious among major banks on silver in the short term, warning of potential further shakeout while maintaining a floor around $75 to $80 per ounce. Citi has issued the most bullish major bank silver target at $150 per ounce by mid-2026, citing acute shortage of physical silver available for immediate industrial delivery. Bank of America sees silver above $100 this year. Goldman Sachs projects silver averaging $85 to $100 per ounce in 2026, calling it the primary strategic metal of the green transition. And Goldman's Citi analysts have explicitly referred to silver as gold on steroids, meaning it will amplify gold's moves, but with far greater volatility in both directions. Wall Street price targets: gold and silver 2026. Bank, source, gold target, silver target. Time frame: JP Morgan, $6,300, $75 to $80 floor, end 2026. Wells Fargo, $6,100 to $6,300, end 2026. UBS, $6,200, $85, mid 2026. Deutsche Bank, $6,000, end 2026. Goldman Sachs, $5,400, $85 to $100, end 2026. Morgan Stanley, $5,700, bull, H2, 2026. Bank of America, $6,000, $100 plus, 12 months. Citi Research, $5,000 plus, $150, mid 2026. Societe Generale, $6,000, end 2026. Section 4. The gold-silver ratio. What it's telling you right now. 8:30 to 10:30. One of the most important tools for understanding the relative value between these two metals is the gold to silver ratio. Right now, that ratio is sitting at approximately 55 to 1, meaning it takes 55 ounces of silver to buy 1 ounce of gold. Here is why that number matters enormously. The long-term historical average of the gold to silver ratio is between 60 and 65 to 1. In major precious metals bull markets, this ratio has compressed dramatically, falling as low as 15 to 1 in 1980, when silver was at its prior all-time high, and reaching 63 to 1 in February 2021, when silver surged during the Reddit silver squeeze. The widely cited rule of thumb in the precious metals community is that a ratio above 80 signals silver is relatively cheap compared to gold, while a ratio below 50 signals silver is relatively expensive. At around 55 today, the ratio is in a moderate zone, below the 80 threshold that screams silver is massively undervalued, but still above the 40 to 50 zone that would indicate silver has fully caught up with gold. Here's what this tells an investor. If gold reaches JP Morgan's target of $6,300 by end of 2026, and the ratio compresses modestly from 55 to 45, still well within historical norms, that implies silver at approximately $140 per ounce. If the ratio compresses further toward the long-term average of 60, and gold reaches 6,300, the implied silver price is around $105. In every historical scenario where gold has made major sustained moves to new highs, silver has eventually followed with a larger percentage gain. The 2025 data confirmed this pattern. Silver's 148% gain dwarfed gold's 70%. The ratio is not a timing tool. It doesn't tell you when silver will close the gap, but it does confirm what every structural bull in this market believes. Silver still has more relative upside versus gold on a ratio-adjusted basis. Section 5. Which metal is right for you? Now let's answer the real question. Not which metal looks better on paper, but which metal is right for your specific situation. If you are a conservative or defensive investor, gold is your metal. Here is why. Gold has a 10-year compound annual growth rate of approximately 24.8%, exceptional by any measure. It has the backing of every major central bank on the planet, with sovereign buyers acquiring 800 tons per year and accelerating. Its $20 trillion market size means institutional investors can move large positions without extreme price impact. And crucially, as the gold advisor's Jeff Clark notes, gold performs better in recessions and stock market crashes, while silver struggles in those environments. Gold is mankind's oldest form of money and should be a cornerstone asset of all portfolios. If the economy slows, if equities crash, if financial stress rises, gold will hold up while silver may not. Gold is the cargo ship, slow, powerful, reliable. If you are a growth-oriented or aggressive investor, silver is your metal. The structural case for silver is arguably even more compelling than gold's in a bull market environment. A 6-year supply deficit with no end in sight, industrial demand growing faster than mine supply can respond. The fastest growing demand sectors, AI, solar, EVs, all require silver and are still in early innings. Silver gained 148% in 2025. Even after a violent 31% crash in a single day, it is still up nearly double what gold has done on a trailing 12-month basis. Citi's target of $150 implies 60% upside from today's $93. That's versus 22% upside in gold to JP Morgan's 6,300 target. The potential return is higher. The risk is also higher. Silver will give you volatility that will test your conviction. You need to be prepared for 20, 30, even 40% corrections within an ongoing bull market, because that is exactly what silver does. If you are asking for the data-driven optimal approach, most institutional analysts and wealth managers recommend what one major precious metals research house calls the 70-30 rule: 70% gold, 30% silver. This structure gives you the stability and reliability of gold as your core holding, while giving silver enough weight to meaningfully boost returns if the bull market continues, without exposing your entire portfolio to silver's extreme volatility. Many financial advisors suggest that precious metals as a whole should represent 5 to 10% of a diversified portfolio. But investors who accumulated positions at lower prices may now find metals representing a larger allocation and should consider rebalancing. Let me give you the bottom line clearly. Gold and silver are both in historic bull markets. Both are being driven by genuine structural forces that have not reversed: dollar weakness, geopolitical instability, central bank reserve diversification, and Fed rate cuts. Neither rally looks like a speculative bubble that is about to implode, but they are different. Gold at $5,163 has JP Morgan's 6,300 target, implying 22% upside and 800 tons of central bank buying, providing a near-permanent demand floor. It is the more reliable store of value, the better recession hedge, and the core precious metals holding for most portfolios. Silver at $93 has Citi's $150 target, implying 60% upside, a 6-year supply deficit, and the fastest-growing industrial demand in the metal's history from solar, AI, and EVs. It is the higher beta play, the one that could outperform gold by 2 to 1 if the bull market continues, but also the one that will punish you harder if things go wrong. If you want safety and reliability, gold. If you want maximum upside in a bull market and can handle the ride, silver. And if you want the best of both worlds, 70% gold, 30% silver. The precious metals story for 2026 is not over, it has barely begun. And whichever metal you choose, stay informed, manage your risk, and never invest money you cannot afford to lose. If this breakdown was valuable to you, hit like, subscribe for weekly market updates, and drop in the comments. Are you Team Gold, Team Silver, or both? I'll see you in the next one.